In this week's market update, haven assets are in focus as geopolitical risks rise and fall. Brexit is in the spotlight as Prime Minister May sets out her stall, and India celebrates 70 years of independence. So the big market story this week continues to be the ebb and flow of risk appetite in response to the ongoing standoff between the US and North Korea. Last week saw a period of relatively calm markets come to an abrupt close after President Trump and North Korea's leader Kim Jong-un engaged in a hostile exchange of verbal threats. President Trump was widely criticised for his language, which echoed that used in wholly different circumstances by President Harry Truman in the days between the Hiroshima and Nagasaki atomic bombings. Trump threatened North Korea with fire and fury like the world has never seen, and that sounded remarkably like Truman in 1945, warning the Japanese that anything less than surrender would result in a rain of ruin from the air, the likes of which has never been seen on this earth. So the repetition, almost word for word, was incendiary, and it prompted a dangerous and precise threat by North Korea to launch 4 missiles into the sea close to Guam. That's a Pacific island that forms a key base for America's naval and air force presence in the region. The market reaction was textbook stuff. Equity markets fell sharply, while haven assets came into favour. Gold rose by 2.2% in 4 days. The yield on US Treasuries fell by 6 basis points over the week, pushing the prices of bonds higher. The Swiss franc rose strongly, and ironically, the Japanese yen also rose, despite Japan being at the epicentre of any potential military conflict. Now, fortunately, by the end of the week, calmer voices seem to have prevailed. On Friday and into this week, the risk trade partially reversed, with equities rising and the havens falling back a little. Crisis seems to have been averted for now, but it was a reminder that 8 years into the current long bull market, investors are vulnerable to a change in sentiment. Indeed, the VIX index, which measures the cost of insuring investment portfolios against volatility, jumped on Thursday, although it remains subdued by historical standards. Aside from the Korean nuclear situation, last week was largely about remembering the financial crisis which kicked off 10 years ago. This week's anniversary looks back even further, 70 years to India's independence. It was on this day in 1947 that India set out on a journey that has taken it in 7 decades to a remarkable position that few would have predicted in the violence of partition. So India now is a country where life expectancy has risen from 32 in 1947 to 68. It's the world's 7th largest economy, valued at $2 trillion, and it's growing fast, by 6.6% in 2016, just behind China's 6.7% growth rate. The long-term growth story remains positive. India's median age is just 27, and 7 in 10 Indians today are under the age of 35. According to PwC's report, The World in 2050, India is expected to grow by nearly 5% a year between now and that year, and only 0.7% of that growth will come from simple growth in the population. The rest is real growth, higher productivity, better technology. So it's unsurprising that India remains one of the most popular emerging markets today for investors. Nick Price, who manages Fidelity's Emerging Markets Fund, describes India as the standout emerging market. In particular, he's focused on the country's growing consumer sector as wages grow and the benefits of a strong education system and the current government's reform agenda kick in. Now, a country with a very different economic and demographic profile to India's is Japan, but it too is in the headlines this week for all the right reasons. Japan's latest GDP figures for the 3 months to June showed an unexpectedly strong expansion by 4% year on year, and that compared with forecasts of just 2.5%. It's more than twice the 1.8% growth rate that's currently being enjoyed, if that's the right word, in the UK. The latest growth figures in Japan mean that the country has now notched up its longest run of positive GDP figures since 2000. The economy has expanded in 6 consecutive quarters on the back of higher consumer spending and capital investment. And this provides a helpful boost to Prime Minister Shinzo Abe, whose popularity ratings are falling 4 years into his Abenomics programme of monetary and fiscal stimulus. So Abenomics is a catch-all phrase for a range of spending and easing measures designed to kickstart the Japanese economy after a generation of stagnation since the 1980s property and stock market bubble burst. After initial success, the programme has stalled more recently as it's proved more difficult than anyone expected to restore growth and inflation. Now, unlike the Indian stock market, Tokyo had been out of favour with investors for many years, but the anticipation of higher growth on the back of an improving jobs market and wage increases has seen Japanese shares come back into favour more recently. Indeed, over the past year, the Topix index has performed nearly twice as well as the more highly rated S&P 500 and about 4 times as well as the FTSE 100, which of course is battling with anxiety about Brexit. So, Britain's attempts to negotiate itself out of the European Union will come into sharper focus this week as Theresa May, the Prime Minister, returns from a 3-week holiday to find that many of her colleagues have taken advantage of her absence to promote very different visions of Brexit from hers. In particular, Chancellor Philip Hammond and Home Secretary Amber Rudd have been calling for a softer exit that puts economic growth first, even if that means being more accommodating than the hard Brexiteers would like on the immigration question. Just how successful they've been in changing the terms of engagement will emerge over the next week or so as a series of position papers are published on issues including the UK's stance on future border arrangements in Ireland and our attitude to membership of the Customs Union. Papers have to be submitted by August the 21st, next Monday, ahead of the resumption of negotiations on August the 28th. Also in focus at home this week will be inflation, which is expected to resume the recent rise towards 3% that unexpectedly went into reverse last month as the CPI fell back to 2.6%. This time round, prices are expected to be rising at an annual rate of 2.8%, edging closer to the 3% level at which Bank of England Governor Mark Carney is required to write to Chancellor Philip Hammond with an explanation of why he's let price rises deviate so far from the bank's 2% target. Rising inflation on the back of the pound's post-referendum weakness has been the principal cloud hanging over the UK economy. Combined with stagnant wage growth, rising prices have crimped consumer confidence and spending power. Now, with growth in the Eurozone apparently back on track and ECB President Mario Draghi expected to unveil a route map towards monetary tightening in Europe, the pound has continued to weaken against the euro in recent weeks. At around €1.10 to the pound, sterling is at its weakest in many years, with analysts suggesting the two currencies could head towards parity, or even that the euro could become more valuable than the pound at some point soon. On the corporate front, results season is now largely done and dusted, but the earnings announcements still left for this week are largely focused on the retail sector. Alongside US retail sales data, these should provide some further insight into the ongoing battle between the traditional high street and the disruptive force of Amazon and others in the online retail space. Key figures to watch this week include Walmart, which is the world's largest retailer, and home improvement chain Home Depot. Having seen the likes of department store Macy's disappoint already in this latest results round, attention will focus on continuing sales falls and margin pressure. Others in the spotlight this week include Target, Coach and Gap. Overall, results season so far has been pretty impressive, with about 85% of US companies having reported already. 3/4 have beaten analysts' estimates. In Japan, the proportion of beats is lower, but the scale of earnings growth is more impressive at 43% year on year. In the Eurozone, just over half of stocks have beaten forecasts, according to Charles Stanley.